Welcome to This Explainer. Look, if you've ever felt just totally overwhelmed by the stock market, or maybe you're actively trying to dodge handing over massive chunks of your hard-earned wealth to financial advisors in the form of crazy high fees, well, you are in exactly the right place. Today, we're diving into a step-by-step masterclass tailored specifically for the U.S. market. We're going to decode a brilliantly simple investing strategy that practically anyone can execute. Let's get right into it.
Here's our roadmap for today. We're going to cover the overcomplicated investing trap, the 3-fund portfolio solution, 5 wealth-building benefits, the exact funds you need, tailoring your asset allocation, and finally, step-by-step annual rebalancing. Oh, and if you find this helpful, please go ahead and hit that like and subscribe button.
Section 1. The overcomplicated investing trap. Okay, let's dive into this. Have you ever noticed how people just love to overcomplicate investing? I mean, they'll spend countless hours building these massive, intricate spreadsheet models, hyper-analyzing daily trends, and trying to magically predict whether a specific stock is going to go up or down. But here's the stark reality about all that wasted time and effort. A shocking new report found that almost 80% of active fund managers actually fall behind the major indexes. Just think about that for a second. These are literal professionals, right? Their full-time job is to beat the market, and 8 out of 10 of them fail to do it. It's definitive proof that complexity absolutely does not equal better returns. All those intricate spreadsheets aren't giving anyone an edge. They're honestly just giving you a huge headache. Section 2. The 3-fund portfolio solution. So what exactly is the alternative to all this stressful forecasting? Enter the Bogleheads. This is a really cool investing enthusiast community named after John Bogle, the legendary creator of Vanguard. They champion this incredibly elegant, basically idiot-proof solution for investing that abandons predicting the market entirely. Instead, the strategy is simply to track the market. It's famously known as the 3-fund portfolio. Instead of picking individual winning stocks, you invest in just 3 broad-based index funds, one for the total U.S. stock market, one for the total international stock market, and one for the bond market. That's literally it. Just those 3 funds encompass over 22,000 different securities worldwide. And because they cover totally different segments, there is absolutely zero overlap among your investments. Section 3. 5 wealth-building benefits. Now, I know it sounds almost too simple, right? But this approach is historically superior to active management for several really compelling reasons. Let's walk through the 5 main wealth-building benefits that make this strategy so incredibly powerful over the long haul.
First and foremost, we have to talk about diversification. Warren Buffett famously said, "Diversification is protection against ignorance." And look, if you're as knowledgeable and skilled as Warren Buffett, hey, maybe you can pick 3 individual stocks, put all your eggs in that basket, and win big. But for the average investor like us, that is terrifyingly risky. If you own 3 stocks and one goes bankrupt, boom, you just lost 33% of your entire portfolio. But if you hold thousands of stocks through broad index funds, well, if one company goes under, you're entirely protected. You barely even feel it.
And this brilliantly illustrates the next major benefit, which is cost. What we're looking at here is SEC data showing an investment portfolio with a 4% annual return over 20 years. Look at the devastating cost of high fees. A fee difference of just a tiny 0.25% can literally drag down your gains by $10,000 over 2 decades. And if there's a difference of 0.75%, that reduces your wealth by over $30,000. It's like a leaky bucket. Those high fees quietly erode your wealth right behind the scenes. So, just to quickly summarize these massive advantages, this strategy is beautifully simple. It's perfectly well diversified. It is extremely low cost. I mean, we're talking average expense ratios of just 0.05% to 0.1%. To put that into perspective, you only pay $5 to $10 a year for every $10,000 invested. Fourth, there is no advisor or manager risk. You completely bypass that standard 1% assets under management fee that financial advisors love to charge. And fifth, because you're literally buying the whole market, it virtually guarantees you'll outperform most hedge funds and active managers over a long period. It never underperforms the broader market.
Section 4. Exact funds you need. All right, we are moving from theory into absolute practice. You might actually want to take a screenshot of this next one, because here are the exact tickers you need to build this portfolio today.
Now, what's really interesting about this slide is just how accessible this strategy is, no matter where you bank. If you use Vanguard, you're not to look at VTSAX, VTIAX, and VBTLX. Over at Fidelity, they actually offer zero-fee index funds like FCROX and FCILX. Schwab has some really great options too, like S to VTSX. But hey, if you don't meet the minimum investment requirements for those specific mutual funds, honestly, don't worry about it. You can buy the general ETFs on literally any brokerage platform, Robinhood, Webull, wherever, with zero minimums. Those tickers are VTI for US stocks, VXUS for international, and BND for bonds. Section 5. Tailoring your asset allocation. Okay, so once you know what to buy, the next crucial step is deciding how much of each to buy. Asset allocation simply means figuring out how much of your investment pie goes into stocks versus bonds. And there's really no one-size-fits-all answer here. It depends entirely on your personal risk tolerance, your specific financial goals, and your time horizon.
Let's look at a few common setups, starting with the aggressive 80-20 portfolio. This allocates 80% to stocks, specifically 64% US and 16% international, and only 20% to bonds. This is an ideal setup if you're younger or just have a higher risk tolerance. Stocks have way more upside potential over time, for sure, but they also come with higher volatility. You really have to be willing to stomach those market swings.
Next up is the equal portfolio. This one divides your money precisely into thirds, 33% US stocks, 33% international stocks, and 33% bonds. Think of this as a wonderfully balanced middle ground for the average investor. It's for someone who wants solid growth, but also craves a little bit more stability than the aggressive model offers.
Then on the totally opposite end of the spectrum is the conservative 20-80 approach. Here, you're holding a massive 80% in bonds and only 20% total in stocks. This is generally geared toward folks who are closer to retirement or just have a very low risk tolerance. Their main priority is preserving their capital. It's also worth noting, by the way, that bonds have been returning a lot better recently just because the Federal Reserve has been raising interest rates.
Now, you might have actually noticed a bit of a pattern in those allocations. US stocks heavily outweigh international stocks across the board. So the crucial point is, why not just split the stock portion 50-50? Well, bringing in international stocks actually adds layers of complexity. You have to deal with currency exchange rate fluctuations, markets that maybe aren't as developed as the US, and sometimes even overbearing or volatile foreign governments. So, tilting the portfolio in favor of US stocks helps significantly reduce that overall complexity and risk. And speaking of risk, if you are going to hold a high percentage of stocks, you really need to understand normal market behavior. According to JP Morgan data, the average intra-year drop in the stock market is about 14%. That means in any given year, your $100,000 investment could temporarily drop to $86,000. For an emotional investor, that is terrifying. But here's the secret. Out of 42 years tracked, 32 ended up with positive returns. The market almost always bounces back long term. So whatever you do, you should never, ever panic sell during those dips. Section 6. Step-by-step annual rebalancing. Managing those emotions is definitely key, but there is one active mechanical thing you actually need to do every year. So grab a calculator, because here is how you maintain your portfolio. Oh, and real quick, if you're finding this explainer valuable so far, please take a second to like, share, and subscribe. It really helps out. Okay, let's move to and see how this builds a rock-solid financial foundation year after year. There's an incredibly simple 4-step framework for annual rebalancing. First, check your new balances. Second, determine your target equilibrium. Third, sell your overperformers. And fourth, buy the underperformers. Let's walk through a real-world example so you can see exactly how this works in practice. Imagine you started with a $10,000 portfolio split totally equally. So you had $3,333 in all three funds. Now, let's say a year goes by. Your overall portfolio grows to $12,000. Awesome, right? But that growth wasn't even. It was primarily driven by massive gains in your US stocks, while your international stocks and your bonds basically just stayed flat. So, your US stocks have grown to $5,333, while the others are still just sitting at $3,333. Suddenly, US stocks make up 44.5% of your portfolio instead of the 33% we planned for. Now, this skew elevates your risk because you're overexposed to one asset class. So, we need to calculate our new target equilibrium. Since our new total balance is $12,000, to get back to our 33-33-33 equal split, we just divide $12,000 by 3. Our new target baseline is exactly $4,000 per fund. To fix this imbalance, you take your overperforming winner, the US stocks, and you sell $1,333 worth. You then take that profit and you split it equally, buying $666 of bonds and $666 of international funds. Boom. You are perfectly rebalanced at $4,000 each. Now keep in mind, rebalancing does not mean withdrawing money to your checking account to spend on vacation. You're just shifting it around inside your portfolio. And ideally, you're doing this within a tax-advantaged account, like a 401k or a Roth IRA, so you don't even have to pay capital gains taxes on that sale right now.
And there you have it. That's the entire blueprint. By embracing this system, you free yourself completely from the literally impossible task of timing the market. So as you look at your own financial future, I want to leave you with this question. Are you willing to keep gambling your hard-earned wealth on the illusion of control? Or are you ready to finally let the market do the heavy lifting for you? The blueprint is yours. Thank you so much for joining me for this explainer. Don't forget to like and subscribe, and I'll see you next time.